So let's start with the revenue. There has been a decrease in revenue of 13.3%, and this was mainly from hospitality. So hospitality used to be about 27% of Elis in 2019, and there was about 50% decrease, and this was basically the whole impact, more or less, because the rest of the business was very resilient. So industry was down 2%, healthcare up 3%, and trade and services minus 3%. And this is also interesting because Elis represents 25% of the European market. So Elis itself has about 93% revenue in Europe. The rest is Latin America. So the impact of COVID-19 on Elis is basically very similar to the impact on the whole industry in Europe. And the share price of Elis is also very interesting. So since the crisis, shares are down about 15%, and when you take the last 3 years, it's 29%. This concerned me a lot, and I was reasoning what is the root cause of these issues, and I try to do an analysis of this in this video, so stay tuned. So a critical comment to some presentations of Elis. They say EBITDA margin is up 20 basis points. Actually, the net profit is down about 140 million from last year. So this is actually the more realistic presentation, which is good. So you would expect even a big loss in the P&L. And if they have a slight profit, then this is actually an achievement. And headline income, they report in headline income, whatever it is, of 139 million. Of course, they show the calculation in the press release, but at the end of the day, the comprehensive loss is 160 million, and you have to add to this a slight profit of 4 million, about 174 million of foreign exchange effect due to the devaluation of Latin America. So at the end of the day, it was not such a good year for Elis. Free cash flow after lease payments is up, is at 217 million and up 43 million from last year. Actually, I do not. You will see afterwards why I'm a little bit critical about this statement. The debt has been reduced by 91 million, which is actually fine because in the last year they had a slight increase in debt. So this is good, but you have to consider that they have also reduced cash by 33 million. So actually the balance is less. So if you reduce cash and reduce debt, then at the end of the day, it's less than 60 million improvement. And they didn't pay dividend as well. So yeah, during the height of the crisis, they had a shutdown of 100 plants. The CEO made this actually as a good remark, that they were very effective in taking measures, which is on the one hand a good thing. So they have obviously a very good management structure where they can react very fast. So this is the good thing. But I do not believe that this has no impact in customer satisfaction. So when you look at a laundry plant and you have your defined routes, you have your agreements that you have with your customers, you have a dedicated item list of each customer. And when you shut down the plant and transfer this customer, because you have always 5, 10 or 20% of customers that are still open, and you transfer these customers to the next plant, you will always have issues there. It's next to impossible that you have no problems there. Just because you do not have many terminated customer contracts, it doesn't mean that you don't have an issue with customer satisfaction. Yeah, and the same applies to headcount adjustments. The question is whether this has a long-term effect. We'll see in the next few years. And also customer satisfaction will basically be visible in 2022 probably. So we'll see there whether there was an impact on the long term. Yeah, EBITDA, 38% of sales, which is actually a quite good number. I think, of course, higher is better, but 33.8% is a very good number in the industry. So congratulations to this. On the other hand, EBITDA is not so much. It's actually a meaningless number when you take it all together. First of all, they have an increase in restructuring cost or other expenses, non-current expenses, of 46 million. So that's 1.7% of sales. So actually the real number should be 32.1% of sales. So in reality, EBITDA is down actually. And of course, the EBITDA is just half of the story, because still you have to purchase textiles, you have to do your investments, amortize goodwill, because Elis buys many companies and you have interest and stuff. So the real question is whether this is a number where you can that you should be concerned with, or whether this is just half of the story. Then they made a statement regarding the reasons why they did so well. And on the one hand, I'm a little bit critical regarding the diversification. They are in 28 countries and 3 continents, which is fine. Although, 3 continents means also Asia, probably, with Russia. They have well-balanced end markets and 3 business lines with 100,000 items or stock keeping units. I see this critical actually, because this is an euphemism for too less focus and too much complexity, and they get this complexity due to their M&A activity. In other industries, you can buy a company and you just change everything and introduce this to the customer and customers, and they in some cases like it or not. I really appreciate their management structure. They did a very good job during the crisis, and they had very strong, forceful reaction, and this helped them a lot. So I think they have a good organization. Yeah, and some other things. They are obviously quite good in cash collection, and so this is a plus. And textile investment is down, actually just 1% of revenue. So it used to be 14.3%, and now it's 13.3%. And this is probably even critical, because you should expect that if 13% of revenue are down, that you should have a greater decrease in textile investments.